Remember what we have discussed from the last class. We basically discussed why CAPM theoretically should be true, right? It's because of competition. Even if there are some deviations in the market, that is, if you can see positive alphas or negative alphas, competition from buyers and sellers will actually remove these positive alphas and negative alphas. And if a market has no positive alphas or negative alphas, then this market is efficient. So the gist of this argument is competition in the market will drive market back to efficiency. That is, market portfolio is efficient because of competition. Of course, that's just a theoretical argument. And whenever you get a theory, you want to test it against data. So next, we look at data. We look at history. And we want to see that using historical data, whether we could find some trading strategies which could give us positive alphas. And in the end, you can see that we can find several results which tell us, yes, you can get positive alphas. And these are actually quite famous results. If you're taking an investment class, then these results are actually quite important because they're really about these modern ways of design portfolios. So the first one is called size effect. What we have found is if you rank stocks from large to small, then you can find out small stocks have positive alphas and they generally have higher alphas compared with large firms. So this violates CAPM because according to CAPM, every stock and every portfolio should stay on this security market line. If a stock or a portfolio stays on the security market line, then there should not be any alphas. And we also talk about this value effect. That is, if you rank stocks by their book to market ratio, then you would categorize stocks with high book to market ratio as value stocks and stocks with low book to market ratios as growth stocks. So the finding is, if you look at the returns of value stocks and the growth stocks, you find out value stocks could give you positive alphas. And this again violates CAPM. So today we would continue to look at the third effect, which is the momentum effect. According to research, if you compare these three effects, momentum effect is actually a more universal and it's a stronger effect. So this is a paper by Jagdish and Titman in 1993. So they find out if you rank stocks by their realized returns over the last 6 to 12 months, and then you will find that the best performing stocks in the past will actually have positive alphas in the future. So more specifically, these best performing stocks will have positive alphas over the next 3 to 12 months. In the end, they find out that using the data from 1965 to 1989, a momentum strategy, that is, you would buy stocks who are past winners, and you would short sell stocks who are past losers. This kind of momentum strategy would actually generate an alpha of 12% every year. So you can see that this is actually a pretty significant result because 12% per year alpha is a very large number. The average return in the US market is about, I think it's about 8% per year for the last 100 years. So if you have a additional 12% return, that is huge, right? So this again shows that you can find positive alpha trading strategies. Again, this violates the implication from CAPM. So after seeing these evidences, you would think, why do we have these positive alpha trading strategies, right? This is actually a very controversial topic. Here, we will just focus on the potential that maybe the market portfolio is not efficient. So, what's the explanation that we can find positive alpha trading strategies? Well, maybe market portfolio is not efficient, so CAPM does not fully capture risks. That is, those positive alphas are not additional returns. They're just returns for compensating risks that are not captured by CAPM, right? Now you might wonder, why is it possible that market portfolio is not efficient, right? So there are two potential reasons. The first one is called proxy error. Remember we discussed the so-called market proxy, right? So when we talk about the chapter on the implementation of CAPM, we said market portfolio actually refers to the portfolio of all securities in the market. It's actually a somewhat difficult thing to obtain. I mean, it's not possible for you to actually obtain all price data for all securities in the market. So you will find a simpler way to represent market portfolio. Now, what's the simpler way? Well, you will use a market index, right? For example, if you're thinking about the Canadian market, you will use the TSX composite index. If you're considering the US market, then one potential candidate for the market proxy is SP 500, which is again an index. However, you can see that there is always difference between your market proxy and the market portfolio, right? Proxy is just a proxy for your market portfolio. It's not actually market portfolio, which means there are some differences. So potentially, maybe the market portfolio is actually efficient. However, the proxy you use in your CAPM model is not efficient. Right? Now, what about this second explanation? Well, second explanation is actually more serious because the second argument claims that your market portfolio is not efficient. Now, why is it possible that market portfolio itself is not efficient? Well, maybe it's because in the market, we have a lot of naive investors. These investors, they will hold inefficient portfolios. And these inefficient portfolios will actually have negative alphas. Maybe in the market, we have also more sophisticated investors. These investors, they will hold efficient portfolios. However, if the market portfolio is the combination of inefficient portfolios and efficient portfolios, in the end, the combined portfolio, the market portfolio, potentially is still inefficient, right? So that's the two arguments we use to justify why your CAPM model is potentially not the best model to use. So now we could introduce a multiple factor model. So the motivation here is if market portfolio is not efficient, then we need some other methods to measure risk, right? So here we will use factor portfolios to capture additional risks which are not captured by the market portfolio. Right? So what are factor portfolios? Factor portfolios are well diversified portfolios according to certain criteria. You will see how do we actually construct these factor portfolios. So why this model is called multiple factor model? Well, because it is a model which uses multiple factor portfolios to measure risk. If you think about CAPM, it's actually a special case of a multiple factor model, right? Because CAPM basically says the expected return of stock I equals risk-free rate plus beta times the market risk premium. This is actually a special case of multiple factor model because this is essentially a one factor model, right? So the one factor you're using here is this, right? This excess return of the market portfolio, right? So this is the one factor you're using. Now let's specifically discuss factor portfolios. What factor portfolios exactly do we want to use, and how do we construct these factor portfolios? The first factor portfolio is our old friend, the market portfolio. So we will not remove market portfolio in our model. We will still keep it. What we will do is we will just adding some additional portfolios. Market portfolio can be considered as a long position in the market and a short position in a risk-free security. So you can see that if we consider this whole thing as a portfolio, you can see that you're putting $1 into the market portfolio, and you're borrowing $1, or you're having a short position in this risk-free security. So that's why we claim that for the first market portfolio factor, we put a long position in the market portfolio and a short position in the risk-free security. Next, we will use Smb portfolio, which is small minus big. So how do you construct this factor portfolio? Well, you will actually rank stocks according to their size. So let's say this is the largest stock. This is the smallest stock. So you will rank all stocks according to their size, from the largest one to the smallest one. Then you will find out the guy in the middle, right? The size in the middle. And then you will oops, let me change the color here. And then you will short sell, right? You will short these large stocks, and you will long these small stocks, right? So this is essentially a long-short portfolio. You will take a long position in small stocks and a short position in big stocks. Right? And this is your Smb factor portfolio. And the third factor portfolio is HML, which is high minus low portfolio. Now, how do you construct this? So you would basically, first you will rank stocks. This time you're ranking stocks according to their BM ratio. Remember what is BM ratio, right? BM ratio is book versus market. That is book value of equity, right? That is shareholders' equity, divided by the market value of equity, which is essentially market cap. Right? We discussed this notion in the last class. And we know that according to the BM ratio, if you have a large BM ratio, right? So we would rank these stocks from the largest BM ratio to the smallest BM ratio. And we know that if a stock has high BM ratio, then it is considered as a value stock. Right? So you can see that here we will find the top 30% and the bottom 30%. For the top 30%, which has the largest BM ratios, these are the value stocks. And we will take a long position in the value stocks. And then for the bottom 30%, that is with the smallest possible BM ratios, these are actually growth stocks. So we will take a short position, right? We will short these growth stocks and we will long value stocks. To be more specific, you will build a equally weighted portfolio, right? So you will put so your long position in value stock is equally weighted, and your short position in growth stocks is also equally weighted. And this is your high minus low portfolio. You can see why this is called high minus low, right? Because you're taking a long position in high BM stocks, and you're taking a short position in low BM stocks. So that's why this is called HML. And then the fourth factor portfolio is the prior 1 year momentum portfolio. It's actually also called WML. So it's winner minus loser portfolio. Now, how do you do this? This is pretty simple. So again, you will rank all these stocks according to their past returns, right? So you're ranking according to past returns. So let's say you're ranking these stocks from the largest past returns from the smallest past returns. And then you will put a long position in the top 30%. So long position in the top 30%. And for the bottom 30%, these are losers essentially. You will take a short position, right? So that's why this is called winner minus loser portfolio, because you're because you're setting a long position in winners and you're setting a short position in losers. Of course, following the book basically calls this portfolio as prior 1 year momentum portfolio. I would say this is a worse name, but anyway, let's follow the textbook here. So now we finally could talk about our multiple factor model. You can see that this model can be considered as a extension of the CAPM model. To be more specific, this multiple factor model is called Fama-French-Carhart FFC factor model. This model is actually a combined results of Fama-French paper and Carhart paper. So that's why it is called FFC model. So you can see that here we have 4 factors, right? So this is a 4-factor model. Right? Again, let's see what kind of factors do we have here. So this can be called as market factor, right? So it's the market portfolio minus risk-free rate. This is the factor portfolio of Smb, that is small minus big. And this is the factor portfolio of HML, that is high BM ratio minus low BM ratio. And then this is the factor portfolio of prior 1 year. Prior 1 year momentum, right? That is, you would take long position in winners and short position in losers. Of course, you can see that here we need several betas, right? So here, this is again this market beta in this factor model. But now you have all these additional betas. These are all factor betas, right? So this beta SMB is the factor beta before this SMB factor. And then you will, to calculate the cost of capital, you will basically use the expected return of these factor portfolios, right? And I also want to remind you that you have to be careful whenever you're using this formula to calculate the cost of capital. The reason is because if you look at this market factor, then you have this minus risk-free rate. But if you are looking at these three additional factor portfolio returns, you don't have this minus RF, right? So you have to be careful with this. So don't add minus RF to all factor portfolio returns, right? This is the mistake committed by past students, right? So you don't want to make this same mistake again. Okay. Okay, great. So here we have the table which tells you what is the average per month return for these factor portfolios. You have to be careful with this table because you have a monthly returns, right? It's not an annual return. So if a problem asks about annual returns, then you have to convert from monthly returns to the annual return, right? And here you have this 95% confidence band. I did not talk about confidence interval in this class, but basically this 95% confidence band gives you an idea how accurate your estimation is, right? So basically, if you look at the first guy, right, the confidence band is 0.34, which means if your estimation is 0.61, then there could be some variations. So you could have 0.61 minus 0.34 and 0.61 plus 0.64. However, there is a 95% chance the correct monthly return will fall into this interval, right? Will fall between this number and this number. Right? So that's why this is called 95% confidence interval or confidence band. But this confidence interval is not required. All you need to do, or all you need to know that you need to know these numbers to calculate the cost of capital using multiple factor model. Okay, very nice. Now let's actually calculate the cost of capital using a example here. So let's say you're thinking about invest in a project in the fast food industry. You determine the project has the same level of risk as investing. Has the same level of non-diversifiable risk as investing in McDonald's. So determine the cost of capital by using the FFC factor specification. So basically the story here is you're using this comparable firm analysis. So you're considering McDonald's as the comparable firm. So you would use the cost of capital for McDonald's as the cost of capital for your investment. So for simplicity, let's just calculate the cost of equity for McDonald's. Right? So here, the problem says you should use the FFC factor specification. Okay, so let's write down the model here. Right? So expected return, which is also the cost of capital, equals risk-free rate plus the market beta, right? Times the expected return of the market minus risk-free rate plus the beta of SMB, expectation of SMB's return, and beta of HML, expectation of HML, and plus and plus beta of prior 1 year times the expected return of this prior 1 year portfolio, right? Okay, now let's see what kind of data we have here. We have an annual interest rate of 1.5%, and we have the estimation of factor beta and factor average returns. So it seems that this is a tremendously simple question, right? What we need to do is we just need to plug in numbers, right? Just plug in risk-free rate and factor beta and average returns. Then we could get our answer. But there's a caveat here. You can see that there is a mismatch in terms of a measurement. You can see that this risk-free rate is measured in terms of annual rate. But here, we're having monthly returns, right? So per year rate versus per month rate. Basically, we need to do some conversion here. So what we can do here is we will convert this annual risk-free rate to the per month risk-free rate, right? So here, so let's just use simple interest, right? So here, the monthly risk-free rate is given by 1.5% divided by 12, right? Because we have 12 months every year. And this is, so what's the number here? So this gives us a per month rate of 0.125%, right? So now we have successfully matched the measure of the risk-free rate with the measure of average factor returns, right? So basically now we could plug in numbers. So now you can see that the beta on the market factor is 687, right? And times the market access return, which is 61, plus the beta of SMB, which is minus 299 times 0.25, and then minus 156 times the return of the HML portfolio. 123 times this. So this gives us a result of 0.49%. This is the per month cost of capital. If you want to, now let's again use this simple interest rate or annual percent rate. So we could calculate APR equals per month rate times 12 months, which gives us 5.95, right? For comparison, we could also use CAPM to calculate the cost of capital here. So let's try to use CAPM. So if we use CAPM model, then we would only need the market factor here. So it's right? We just plug in these numbers, which gives us let me see what's the number here. So this gives us 0.454, right? 0.454, right, percent. This implies a APR of 5.5. Clearly, you can see that we are having these two different models. So we should have slightly different answers, which is a very natural and expected result here. Of course, we could also observe the difference in the annual percent rate. So to summarize, this is a very easy problem. However, in the past, a lot of people made this mistake because they forgot to adjust this annual risk-free rate to this per month risk-free rate. So that's the only caveat here. Okay, now let's talk about the last section, which is other methods used in practice. This is a very short section. However, I would say this is actually pretty important because when you're hunting for a job, you really want to know what kind of things are useful, right? What kind of things are actually used in your firm, in your organization. So now we ask, what kind of methods do financial managers actually use to calculate the cost of capital? Well, in the end, it really depends on the firm and even the industry, right? So so there's no universal answer to this. It may depend on your supervisor, right? It may depend on what your colleagues are using, right? So a 2001 survey of 392 CFOs by John Graham and Campbell Harvey, they found that 73.5% of the firms, they would use CAPM, right? So you can see that CAPM is a really important model. And you can see why a lot of firms would want to use CAPM. It's because of simplicity, right? You only need the risk-free rate, beta, expect return on the market portfolio. Then boom, you get your answer. So that is easy, right? And then they also find larger firms were more likely to use CAPM than those smaller firms. So I guess CAPM is somewhat a fancy tool. And maybe for small firms, they just want to use average cost as a measure of cost of capital. Now, there is 1/3, right? 1/3 reported they actually use a multiple factor model to calculate the cost of capital. So you can see that even multiple factor model is a much more complicated and longer model compared with CAPM. It's actually still widely used, right? 30%. Some firms also use historical average returns, 40%, and the dividend discount model, which is 16%, to calculate the cost of capital. You might wonder, how do you use the dividend discount model to calculate the cost of capital? This is actually related. Okay. Yeah, we actually talk about this, right? Think about when we try to estimate the return of the market, right? There are basically two approaches. You could use past market returns, and you could also use this dividend discount model. And in that section, we discussed the idea is generally if you use dividend discount model, your purpose is to calculate some price or to calculate the present value, right? So you would use dividend divided by the discount factor minus the growth rate. But if you manipulate this formula, you could find out R equals dividend discount, R equals dividend divided by price plus G. So you can see that in this case, the dividend discount model will give you a estimation on the cost of capital. This R here can be considered as cost of capital. Right? So this is basically a summary of different methods, right? You could use CAPM, multiple factor model, dividend discount model, and you could also use the average historical returns. And you can see that if you add up these numbers, this is 70%, this is 40%, and 33%. You can see that the total of these percentages is larger than 100%. What does this tell you? Well, it basically says that some firms, they will use multiple methods to calculate cost of capital. This is understandable, right? If you want to get a robust result, you wanted to use different models and see how your results will change. And you want to compare your results obtained from different models. So if there are large differences, maybe you want to know why I get large differences. Then if there are very small differences across multiple models, maybe you could use the average of your calculations from different models as the estimation of your cost of capital. Right? Okay. Sorry. Let's finish this chapter with these several review questions. First, if investors buy a stock with a positive alpha, what is the positive effect on its price and expected return? So basically, according to CAPM model, okay, so we have beta here, and we have expected return here. So every stock should stay on this line. Let's say now some stock has this positive alpha, right? So let's say this guy has positive alpha, and this distance is positive alpha. Now what would happen is, you can see that now because of the positive alpha, this stock becomes a very attractive investment. So a lot of traders will rush to buy this stock. If a lot of buyers rush to buy this stock, what would happen is the stock price or today's price will increase, right? And then its expected return, which is essentially the expected price in the future, divided by today's price minus 1. Then its expected return should decrease, right? So the answer here is price increases and expected return decreases. And this is the so-called competition force we discussed, right? So if this happens, basically, you can see that the alpha will generally disappear, right? It will go back to this line, and the market will go back to efficiency. What does the existence of a positive alpha trading strategy imply about market efficiency? The second question can be explained by using the same picture we just drew, right? If the market is efficient, then every stock should stay on this security market line. However, if there is a positive alpha trading strategy, it implies that you can find a portfolio which deviates from the security market line. So this implies that the market portfolio is not efficient. What is the advantage of a multiple factor model over a single factor model? So when you're using a single factor model, maybe because you just have one factor, you would fail to capture all risks, right? So if you're using a multiple factor model, then you have more factors to capture additional risks which are not captured by a single factor model. So that's the benefit of using a multiple factor model. What is the most popular method used by corporations to calculate the cost of capital? This is directly related to this graph here, and we can see that The most popular model is CAPM. But again, as I said, it's also important for you to understand there are other methods, right? Such as the very simple average historical returns and the model, multiple factor model we just discussed about. What other techniques do corporations use to calculate the cost of capital? Again, it's about this picture, right? I have shown you all these methods used by corporations to calculate the cost of capital. Okay, that's great. Well, I think I'm a little bit of too fast in this semester because of online teaching. Um, okay, I'll try to slow down a little bit. Okay, unfortunately, still now we have reached the second large part of this class. So we basically have finished the first large part of this lecture. So basically, we discussed CAPM, and the purpose of discussing CAPM is to use CAPM to calculate the cost of capital, right? So all our previous class were centered on how to understand CAPM, how to understand the portfolios, and how to calculate the cost of capital. And now, what is the second part about? Well, it's about capital structure. So what is capital structure? It's essentially about the firm's choice of equity versus debt. Remember that when you're financing a project, you have at least two sources of financing, right? You could use equity, you could use debt. In terms of a public firm, if a public firm has a project, it could issue a corporate bond. Then this firm is using debt to finance its project, or the firm could borrow money from a bank. So using bank loan is also a form of debt. And then if this is a public firm, the public firm could also issue some additional equity in the stock market. So in this case, the public firm is using equity to finance its operations. So you can see that it's actually an important topic to discuss what is the optimal level of equity versus debt. Now we start with a simple case, which is the textbook chapter 17. So here we will consider a hypothetical scenario. That is, we will consider a world with no taxes. You can see that this is not realistic. But what's the purpose of discuss a unrealistic case? Well, it's a good starting point and it's a good benchmark case, right? It's a good baseline case. So we basically want to understand what kind of results we can get if we're living in a perfect world without taxes. And then we will move on to the next chapter to think about more realistic cases. That is, what would happen if our world actually has taxes, right? So let's first start with this simple case. So in this chapter, we will assume perfect capital market. Now, what kind of assumptions we need to satisfy this perfect capital market? First, we need all securities are fairly priced. This essentially says there are no arbitrages in the market. And second, we need the assumption that there are no taxes and other transaction costs. And here the key here is no taxes. And a lot of the choice of capital structure will be about how taxes will affect your choice. So here, by assuming no taxes, we're really making our life easier. And then the third assumption is also important. It assumes that the total cash flows of the firm's projects are not affected by the firm's capital structure. So here it basically says that a firm can modify its use of financing, right? You can use more debt or less debt. You can use more equity or less equity. However, its choice of equity versus debt will not affect the cash flows from its project, right? So it's sort of like a independence, or it's kind of like a independence assumption, right? It basically assumes the results, the performance of your project is independent of your financing, right? Okay. So now let's start let's start with a very simple example. So here we're looking at a simple example with an entrepreneur who wants to finance his adventures. The takeaway from this examples, there are basically two takeaways. The first is the entrepreneur will be indifferent between financing using equity and financing using equity and debt. The second takeaway is using debt will increase the risk of equity. So let's see how we can get these two takeaways from this example. So here, this entrepreneur is thinking about making an investment of $800. So this is essentially the cost of this investment, or the initial cash outflow of this investment. And what kind of returns the entrepreneur can get? Well, with the 50%, the economy is great. So the cash flow from the project would be $1,400 next year. And with 50% chance, the economy is bad, and the cash flow from the project would be $900 next year. So here you can see that we have the timeline and associated cash flows in this table. So on day 0, a cash outflow of $800. On day 2, we have two cases, right? Under strong economy, 1,400. On a weak economy, 900. And now first, let's think about what is this project's NPV. So to calculate NPV, you can see here we have cash flows, right? Which is great, but we don't have the cost of capital. So let's say here we assume, well, because you can see that the cash flows depend on the state of the economy. So the cash flows, that is, these two cash flows, they contain systematic risk. So basically investors, let's assume investors will demand a 10% risk premium over the risk-free rate of 5%. So let's assume the cost of capital is 15%. Now the NPV is very easy to calculate, right? So NPV equals today's cash outflow plus the expected cash flow in the future, right? You can see that we're using the expected cash flow because strong economy and weak economy each happens with 50% chance, divided by the discount factor, which is the cost of capital, 15%. So this gives us 1,000. This gives us minus 800 plus 1,000, right? Which is 200. That is, the present value of this project is 1,000, and the net present value of this project is 200. Now let's talk about financing. So here you can see that the entrepreneur wants $800 to make the investment. So let's assume the entrepreneur absolutely has no money. So the entrepreneur has to raise some money to finance his adventure. Okay? So here, first, let's say the entrepreneur would finance his project use only equity. If you're financing a project using only equity, this equity is called unlevered equity. Unlevered basically means no debt, right? Because your firm or your project contains no debt. So the equity in your project or in your firm is a unlevered equity. Now the question is how much money the entrepreneur can raise by only using equity. Well, this is actually pretty simple, right? If you look at this table here, right? So basically, these investors, if they give this entrepreneur money, then you can see that these investors, they will just have these cash flows, right? 1,400 and 900. So in the end, you can see that the present value of these two cash flows is given by 1,000. And this is exactly the amount of equity this entrepreneur can raise, right? So the present value of the equity cash flow is 1,000. That is, in the end, the investors, they will be happy to give the entrepreneur $1,000. That is, the value of the equity in this firm is $1,000. And given this $1,000 value of equity, we could also calculate the returns for unlevered equity, right? So you can see that if economy is strong, the cash flow is 1,400. So the return would be 40%. And if the economy is weak, then the cash flow would be 900. So the return would be minus 10%. Here you can see that if you look at the average return here, right, it's 40% minus 10% divided by 2, which is 15%. And you could also see the difference in the return here, right? It's 40% minus 10%. So the difference in percent is 50%. That is high return minus low return gives you 50%. Now let's look at the other case. The entrepreneur could also choose finance this firm using both debt and equity. So let's say the entrepreneur decides to borrow $500, right? So this is his debt. And then the entrepreneur will sell his firm, and the other portion would be in the form of equity. And compared with unlevered equity, if a firm has both debt and equity, then the equity in the firm with debt is called levered equity. Right? Levered essentially means with debt. Right? And now let's say if you look at the cash flow here, the firm will have two cash flows, right? This and this. And both of these cash flows are larger than debt. Right? The firm has only $500 of debt. This implies what? This implies debt is risk-free. So this implies the cost of debt is just the risk-free rate. Now let's assume, we have assumed this. We have assumed the risk-free rate is 5%. So you can see that the rate on this $500 debt is 5%. Okay, now let's ask this question. If the entrepreneur decides to sell equity, what is the value of the equity here, right? Again, this is actually pretty simple and even pretty obvious. So we have learned the present value of the firm's future cash flows is given by 1,000. And we know that the firm will borrow $500. That is, the value of the debt at date 0 is $500. And we know that the cash flows go to debt holders and equity holders should be the same as the project cash flows. So this implies that the value of the firm equal to the value of debt plus the value of equity, right? So the value of firm equals the value of debt plus the value of equity. In this case, you can see that value of equity has to be equal to $500, right? Again, let me emphasize, why do you get this equivalence here? This is because, I think I have a, okay. This is because the cash flows of the debt and equity sum to the cash flows to the project, right? If cash flows of debt and equity equal cash flows of the project, then the total value of debt and equity has to be the same as the total value of the project, because value is essentially discounted cash flows. So if you have the exact cash flows, then you will have the exact value, right? Essentially, this is the result of law of one price. So this tells us the levered equity will have a value of $500. You could also find out what kind of cash flows debt holders and equity holders can get. You can see that no matter whether the economy is good or bad, debt holders will always get $525. This is essentially 500 times 1 plus 5% interest rate. And you can see that if economy is strong, the total cash flow would be $1,400. So this implies you will have $875, right? Cash flows go to the pocket of equity holders. So here, this guy essentially equals 1,400 minus 525. Same thing with the weak economy case. The total cash flow would be 900. So the money left to equity holders would be $375, which is essentially 900 minus 525. Right? Now let's summarize our findings. Right? So let's ask, should the entrepreneur prefer equity financing or financing with both debt and equity? Well, the answer is the entrepreneur is actually pretty indifferent between these two choices. The reason is because under both choices, the values would be the same, right? Basically, the entrepreneur will raise $1,000 if he uses debt and equity. And then he will again raise the same amount, $1,000, if he uses only equity, right? So you can see that the entrepreneur will be indifferent between these two forms of financing. Right? Next, let's talk about the effect of leverage on risk and return. So here we actually talk about the returns of the unlevered equity, right? If you look at the calculation here, we know that the unlevered equity has a average return of 15%, and the difference between the two returns is 50%. Now we could also calculate what is the return of this levered equity, right? So if you calculate the return of the levered equity, now here what you can see here is, well, we have got these numbers, right? We have said if economy is strong, the levered equity will be worth $875, and if the economy is weak, then the levered equity will be worth $375. So given these two numbers, you can surely calculate the return of the levered equity, right? So for example, for this case, right, the return is essentially 875 divided by 500 minus 1, which gives you 75%. Right? So you will get this number. And similarly, using the initial value and the weak economy, and the value under the case of weak economy, you will get minus 25%. Now, let's focus on this column here. So if you look at the return here, you can see that debt, obviously, always has the 5% return, which is essentially the cost of debt risk-free rate. And levered equity has a higher expected return, right? 25%. Again, 25% is just 1 over 2 times 75 plus 1 over 2 times minus 25. And unlevered equity has a lower return, right? And you could also think about risk. If you look the difference of these two guys, well, we have talked about this. You have 50% difference. And here, you have 100% difference, right? So what kind of result you can get here? So you can see that essentially, you can see that levered equity is actually riskier, right? How can you see this? Well, because the total variation in the return of the levered equity is 100%. But the total variation in the unlevered equities return is only 50%. So you can see that it's as if the levered equity is twice risky compared with the unlevered equity, right? So that explains why you get 25% expected return for the unlevered equity. It's really because as an investor, you're bearing a larger systematic risk if you're investing in levered equity. So you actually demand higher expected return compared with the case of unlevered equity, right? Okay, I will stop here because, as I said, the course pace now is or has been super fast. So I will stop this lecture like several minutes early.